There's lots of talk today about interest rates and inflation, so let's take a look at why. Economists are worried that a recession is looming, caused by stagflation, a mix of slow growth, high unemployment and increasing inflation, with experts saying that inflation rates could hit double figures in the next few months, maybe even go as high as 15%. Well, if this happens, the price for essentials will rise a lot quicker than our wages. Now, one of the ways that the Bank of England could curb this is by raising interest rates, which they did today, increasing them from 1.25% to 1.75%. It's the biggest jump we've seen in 27 years. Now, this will in turn make life and mortgages more expensive, and in theory, encourages people to borrow and spend less. Well, lower demand should equal lower inflation. However, the governor of the Bank of England has said that the inflation that we're seeing at the moment is largely due to issues like the pandemic and the rise in energy and food prices due to Russia's invasion of Ukraine. So it could be difficult to use interest rates to have a direct impact on inflation, but it will reduce demand, which should overall help to stop those rates hitting double figures. So, will this increase in interest rates affect us? Well, if you own your own home, there's a high likelihood that you have a mortgage. And if you're on a fixed rate, that won't change. But if you're on a variable rate, your monthly payments will now go up. Now, even if you rent or own your own home outright, these changes in interest rates could still affect you through the interest that you pay on things like credit cards, bank loans, or car loans. And lastly, the amount that you earn on your savings, if it's not on a fixed contract or a bond, could be affected by the change in interest rates that we saw today. Well, I hope that this has been helpful. And as always, let us know if you found this video useful and what you'd like to hear about next.